Hi traders, welcome to this FXDD webinar, live webinar here on how to understand the market structure. This is part 3, the advanced session. We already had 2 other parts, part 1 and 2, looking at the beginners and intermediate aspects which you can find on the FXDD YouTube channel. My name is Chris from Elite Currency and thanks for joining tonight. Before we start this webinar, please take a look at this risk disclaimer. It explains the fact that trading for exchange and financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. And this webinar is for informational and educational purposes only. All right, so once again, FXDD YouTube channel is very useful for all the videos that we are doing with FXDD, so you can keep an eye on that. Market structure is basically analysis of charts. And how do you analyze charts? There are multiple ways, but I like to use this triangle. This is what we explained in the previous parts. Once again, it's about patterns, chart patterns, candlestick patterns. It's about trend, range, impulse correction, and support or resistance. By analyzing these elements, you understand the chart in a deep way, but you kind of organize your thoughts in a clear way. And at the same time, you can see the charts in a deep, in a 360-degree view, but not spend necessarily 30 minutes. Of course, it may take some time at the beginning, but if you get some experience in it, you can do this 1, 2, 3 minutes. Depends how much you like, of course, the chart. The more time, the more you like it, the more time you might spend on it. But you can do it fast and still have a deeper understanding. That's kind of the idea behind using these 3 elements, this triangle. Now, once you decide if you like a chart, then of course you want to trade it. If you don't like it, you'll move on to other charts. Once you find a chart that you want to trade, then it's about finding an entry, finding a way to trade it. We talked about this. This is the triangle for trading, decision zones, entry triggers. Decision zones is basically, in a way, a different word for point of confluence, point of control, are other words that are used. But in my view, decision zone is a little bit higher in the hierarchy, because point of confluence could be there, but it doesn't mean necessarily that you would want to trade there. A decision zone is something that you decide, like, I want to trade in that area. So there could be multiple points of confluence, but maybe only 1 or 2 or 3 decision zones that you really want to trade. So a decision zone is like an elevated, a more important point of confluence for whatever reason, because of multiple support or because of a combination of support, patterns, and trend, right? Once you've identified a decision zone, then you're looking for a way to enter, you're looking for a trigger and an entry then based on that. We talked about that in the last part. So we're going to dive into combining all of these things in more detail. I would definitely look forward to your feedback, because this is more where I want to interact, if possible, with anything that you have on your mind. Before we look at the live charts, though, if you're looking at the recording on YouTube, look at these links here for live trading webinars, so you can join live. The above link is live trading webinars, and the bottom link is live educational webinars. All right, that said, let's move on to the charts. And this is the wrong button. Thank you, Ali. I appreciate that. The little one is doing well and growing, so we're happy about that. And I saw your email as well, and it's definitely on my list to write back as well, by the way. But it is. I didn't have the time. Indeed, it is quite busy with the small one, even though he's not yet at home. So, but yeah, it's really a great experience indeed. Thank you for all those wishes. And yeah, I want to, this is an advanced session. So in this part, it's really about combining everything, one thing is knowing it on paper. I think that if you discuss these topics with someone who's been looking at trading for even a few weeks or a few months, it makes already a little bit of sense. If you talk to someone with already 2, 3, 4 years of trading, it probably makes a lot of sense. But the next step is really about how do you make decisions with that, right? And as I said yesterday, you don't necessarily have to make trading decisions based on this analysis. You could use this analysis and use it as a way to improve your strategy, filter, the setups that you like the most, or you can actually trade with it. It depends on your preferred trading style. Are you more of a discretionary trader or more a rules-based trader? If you're a rules-based trader, you might want to use this only for filtering setups. If you're more of a discretionary trader, then it's a question of how do you weigh all these aspects? How do you come to a conclusion with all this information in a way? How do you focus on what's important? How do you filter out all the irrelevant things? And this is a question of experience, of course, but that's, I think, the main key. I think that, the first two parts were really talking about the just like the practical things, and that is quite straightforward. And today I really wanted to focus on how do you really do it in practice. Now, first of all, are there any questions that you might have? Is anyone already something unclear maybe from the previous two? Is there anything you would like to discuss? Please let me know. In the meantime, I wanted to walk through an example. So let's look at the euro dollar and pound dollar. Okay. Maybe some of you looked at my euro dollar pound dollar analysis with Elite Currency and with FXDD today by any chance? Is there anyone who viewed the live webinar or the video by any chance? We'll take a look at, okay, no problem. Well, it doesn't really matter. I was just curious. We're going to take a look at the euro dollar pound dollar, my analysis of today, discuss that, go through it, kind of in a way pick my brain a little bit, right? What I was thinking at that time and how it played out. Then if you have a particular currency pair in mind, just let me know. Okay. So, generally speaking, using multiple time frame analysis does not hurt. All right. And it's not a must necessarily, but I think it does give perspective. So, what you can read from, for instance, the weekly chart, right, is that, and you cannot, you don't want to necessarily focus on all the factors on all time frames, but on the weekly chart, I saw, for instance, and I don't think I mentioned this specifically in today's video. I think I did maybe recently or like, because this is a long-term pattern, but a long-term pattern that's available is this 5-wave pattern here, as you can see, like this, a 5-wave pattern like this. All right. And you see that price has made a little bit of a double bottom or slowing down in its pace. And then we had, for instance, here 2, 3, 4, 5, 6 candles, not breaking this bottom. So you see some kind of correction take place. You saw a clear momentum to the upside, to the downside. And then we see a correction. So at this moment, there's a bullish correction going on. And is that correction finished? In my view, probably not yet. I'm expecting some bigger bullish corrections. So from this perspective, you see price is at support as well. So unless there's some clear bearish candles that would break through this 112.50 support zone on a daily chart, maybe even a weekly chart, yes, there is a fairly good chance of a bounce. Not saying that necessarily means that we should trade it right away, but we got to keep in mind that there's a fair chance of that. And if we get bearish candles, daily chart, weekly chart, that break through that level, that of course would change perspective. That would change the odds, and we might be then in that case looking at a bearish breakout. So this is long-term analysis, but still might help us a little bit with certain vision. More importantly, on the daily chart, we were saying today, I was saying that this is looking like a three-wave up. Well, not only today, I've been saying that for a while, but a three-wave up here, a three-wave down here, and clear daily candles bouncing off of this support zone. So if you like wave patterns, then it looks like ABC, ABC, and we would expect upside after that. All right, after this particular pattern or combination of swings. But if you don't like wave patterns, we see, for instance, bounce 112.50, clear wick here. Then we see bullish candles as well. And we see here we had some wicks at the top indicating some pause, but yesterday was a bullish candle. And that's clearly what I said today is that, yes, these in the weekend I said these are bearish candles that probably, there's a good chance that we might get a retracement. But because of yesterday's bullish candle that broke above the high of the day before, the retracement was less likely, and an immediate breakout became more likely because of yesterday's bullish candle. So we also had two, this is the sixth day yesterday that didn't break the low. So the swing is officially completed from my point of view, the bearish swing, and there's a good chance we're looking at a bullish swing at this moment. I also said on the 4-hour chart that we're looking at a uptrend channel. We are looking at the fact that price is being squeezed in between the long-term and the short-term moving averages, but such a squeeze often breaks with the momentum. Here's the momentum. Here we had a flag which already got broken. The bull flag got broken to the upside. It was just a slow break. And today I was saying, therefore, because of this particular analysis, price is clearly above the 21 EMA. That a pop up, specifically, I said, was more likely. And then we would have to see once it gets to the target that we had in that I had in mind at the R2 and the top of the channel at 114.25. We'll have to see how price responds to that level, whether this is a sustainable, a bigger breakout going to occur. Whether price moves up, that's what we expected. But whether price falls quickly like this, or whether price makes a flag like this. That will say a lot. If it makes a flag, we expect more upside. And if it moves down a lot, got to be a bit more careful. We'll have to reanalyze it. It depends. So I'm not sure if we looked at the hourly chart today. Not sure if that was needed. So sometimes it's not needed. Sometimes it might be good. I don't think it had any particular value today. Now, so what things were the primary factors in this analysis? In today's video and today's live webinar with FXDD, and the video was with Elite Currency, we were looking primarily at the daily chart. That was a candle. All right, a candle. This daily candle was a primary factor. That the swing was finished and that we were likely to start a bullish swing because this was day candle number 6. I'm not sure if I said candle number 6, but that was one of the reasons that I thought that this was going to start a bullish correction. So that's the second. So it is basically two things: patterns, right? The swing pattern is finished. The time pattern is finished. We have a bullish candlestick pattern, okay, or bullish candlestick in general, and the bounce off support. Okay. On the 4-hour chart, we were looking at uptrend channel, another flag, which is a chart pattern, a bullish swing, which is a momentum pattern, and the fact of the moving averages, excuse me, that were indicating that, when the 21 EMA like this, when price is staying above it like that, the 144 EMA can act as resistance for a long while, but typically, if it's a battle between the both like this, yeah, typically you get that break actually with the 21 EMA. Not always, but on average. So moving averages is another factor here. So you basically a couple of factors here: the trend, once again, the momentum, the chart pattern, and the moving averages. 4 things on the 4-hour chart and 3 key things on the daily chart. So 7 key things. Now, which things I choose or are chosen here, it really depends on what the chart gives, what you see, and you got to basically keep an eye on it and how the chart is moving along to update that analysis or not, as we indicated yesterday, whether you stick to your analysis or do you change it. And if you change your analysis, does that influence and impact your trade management? I don't want to talk about trade management, but of course that's important too. All right, so I was talking about 113.70. The price has not moved too far from our breakout area, in fact, right? But you can see that there is some good bullish momentum at this moment. Now, in our ECS Live channel, for that are joining from that community, know that we're trading the euro dollar to the upside at the moment through our SWOT Ultima system, right? So Ultima system is indicating the upside, and but if you're looking at it discretionarily, probably this fractal I think is a useful point, and I think that this breakout candle or this, or maybe even this one, the thing is that this is not technically a breakout candle, but the close is so clear near the high that when price is approaching a support with so much control, it typically breaks. So it could have been something to think about. Now the price has not gone too far, 20 pips. One trade is at break even. One of my trades, our trades, is at break even. And Mislav has informed that channel of that. So the other one is still open. So, but that was the analysis behind that. Does that make sense? Ali went long on the euro pound instead, and it did make the retracement indeed. I did think that yesterday it could make the retracement into that 112.80, 113 zone, but reason why I changed that was, one of the main reasons was actually yesterday's bullish candle. That's what I explained in the video, and indeed we're getting some more upside, slow, but something indeed. So that was the analysis behind that. Does that make sense? I know, when hearing it from me, it might make sense. And if you do it yourself, you might wonder how to analyze it. So it's always maybe easier to hear it than do it yourself, I guess, or at least I've been told by some traders. But feel free to ask any follow-up questions. Thank you, Ali. Appreciate that, and really nice of you. And main reason why I want to explain that is that you kind of get a structure, kind of get a blueprint how you can do that as well in a similar way, basically. At a pound dollar, we were looking at clear momentum to the upside, correction to the downside, bounce down, break of the trend line, resistance trend line, break above the 21 EMA, very strong candlestick above the 21 EMA. Then we said if it does make a retracement, look for about halfway the candle at around 130, 129.75 for a bullish bounce and a continuation. And if you do get that, that looks like a continuation potential there. So once again, A, B, C zigzag. The wave B was corrective. The wave A was impulsive, expecting a wave C. We got the bounce in the fib zone as expected. We got the break of the trend line as expected. We got a strong candlestick that closed above the 21 EMA as well, and the trend line. Then we got a retracement into the expected support zone and a bounce. That daily candle from 2 days ago confirmed the bounce with a big wick at that zone. And that's about it for the daily chart. Then the 4-hour chart. made a, you can see impulse to the upside, ABC correction to the downside, bounce at the 21 EMA, bounce at the 38.2 fib, and we had a very strong bullish candlestick here. All right, so that kind of confirmed the wave 4 of within the wave C. Once again, indeed, Ali, it is as I was explaining on the daily chart, indeed A, B, C, indeed. And within that wave C, we're probably looking at a wave 1, 2, 3, 4, and a 5 at the moment. So this candlestick on the 4-hour chart, after bouncing at, this is a different fib, hang on. After bouncing at the 38, we got a bullish candlestick pattern confirming the wave 5. But if you wanted to be more safe, you could have waited for the break of this trend line with the candle close above it. This candle, or this candle could have been options as well. And that was a break for that wave 5. When I was analyzing the charts, however, this morning, so all of that was valid for this morning as well, but specifically price was about here. All right, and you can check the YouTube videos on the FXDD YouTube channel or Elite Currency YouTube channel. The price was about here, and I said specifically that this is an ongoing momentum, that it's more risky to trade at this spot, but the momentum could continue. We were in an impulsive price action, and there is a potential for price to make a follow-through today. What you want to see is a candle that could break above the R1 and close near the high, and then look for a retracement, probably back around that R1 at around 131.40. I think I mentioned 131.25/131.50. So what happened was we actually got a continuation up to the R2 first, as you can see. Now we can take a look at the hourly chart, right? But then we did get that retracement into the R1, back into that 131.40, 130.50 zone. And if you waited for that particular zone, and you managed to catch that zone, then that trade went, or that price moved a lot to the upside at that spot. Now, whether you managed to catch that, that depends on how you trade your triggers and your entry. It depends how secure or how confident you are about that setup. A setup like that would not be tradable on an hourly chart even. Chart, because the candlestick, to confirm that bounce, well, you could, but you would be entering it all the way here and you're up a few pips only, so. But if you waited for a 15-minute chart, perhaps, let's see, then yeah, this bullish candle or this bullish candle, or yeah, this one, well, this one possible, but price didn't, this basically didn't go much. It's already quite a big candle. So if you're waiting for the trendline break, for instance, this could have been. So those depends how you trade it. That's the decision zone was clear in the analysis. If you have depending on how you trade it, you either traded it or not. If you had a trigger, then on a lower time frame, yes. On a high time frame, maybe, but quite late. If you had a pending order, that would have been good in this case. So yeah, basically potential setups here as price broke, and potential add-ons here, although it was risky as part of the momentum. Let's see, last week, yes, indeed, that was here as price bounced at Friday, and that was 129.70 indeed. And that's where it bounced here, but that was quite late on Friday, I guess. Yeah, it was somewhere on Friday, and then we had the reaction. If you missed this particular fib, this zone at 129.70 or 130, then the next opportunity would have been these breakout candles, or even this candle, or the breakout candles, or maybe both. I don't know if you like it a lot. And then the next one we mentioned was really this breakout candle and a retrace of that candle into this zone. Now, triggers and entries are important because you might have great decision zones and you might have great ideas about how to trade it. But of course, you got to find the right trigger. You got to find the right way of tackling how to enter that decision zone and find the entry for that decision zone. And sometimes you're going to miss, even though you did analyze it and you were waiting for a trigger, and you just might miss the entry. And that's part of trading, it's part of life. You know, if you are monitoring the charts, but you might just miss it, it's possible. So yeah, that is very important. And I think candlestick patterns are very useful. I like that a lot with, you know, and specifically with bounces and breakouts. Now, if you're looking to trade a momentum, you might be a little bit late, as in this case here. And then maybe a pending order could be good, or looking even at very low time frames, or looking at candlestick patterns on lower time frames, or looking for fractal breaks on lower time frames, breaks of candle highs, even bounces on lower time frames with some candlestick confirmations. Could be useful, right? So pending orders are specifically good if you really have a lot of confidence in the setup. If you're less sure, then probably looking for more kind of confirmation in terms of candlestick patterns, or a candle break, or a fractal break, a candle break above a fractal, a reaction to a fib with a candlestick, or a reaction to a fib and a close above a moving average. A fractal indicating could also indicate a bounce, right? We have, when this candle closed, we had a fractal here. That could have been already a useful information. Let's see, anything else? Trend lines, break of trend lines, candlestick versus trend lines. Trying to think. Well, as you can see, candlesticks are quite important in my view. But we can use, so yeah, from that point of view, I like them a lot as a trigger and entry. But I use it in combination with other factors, as you can see, moving averages, trend lines, pivot points, fractals, right? Moving averages, or I think I said it already. Okay. Now, don't get discouraged if you might miss an entry despite your good analysis. And try to avoid revenge trading and stuff like that. Yeah, it's a pity that your analysis didn't deliver you kind of the results and the pips that your analysis deserved. But you know, then again, be happy with the fact that your analysis is working out, and see it as a process. I mean, at the beginning, you want to just check how your analysis is doing. Is the chart showing what you expect? Is it confirming what you expect? I mean, no one's going to have a 100% record on this. But then again, if you do 100 of those analyses, right, and I don't know, 5 times, you know, it worked out more or less as you planned, and 95 times it was really totally different. You know, don't think about the trading maybe as yet, but you know, start, you know, work on the analysis, try to get that up, right? Once again, it depends on your trading style too, right? And what time frames you trade, and if you're trading discretionary or rules based. But you get my point. You know, you want to practice and get to a maybe a little bit of a higher a level first before using that for trading. How can we got a question from Ali. How can we keep the stop loss small in breakout trades? A fractal flag break. So we have a flag, bull flag, let's say. We can look at this pound dollar example, and then we'll look at the euro pound. And we get a break of that flag, and perhaps of the fractal as well. I think that's what Ali means, both the fractal and the flag as a breakout. So it's a great question. because we talked about entries, maybe not that much about stop losses, indeed, not at all, I think, actually. So let's take a look. So in my view, if we look at these candles, these are small candles. So I would not use these candles for stop loss placements. But this candle is quite big and strong. So I think it's fair to say that at this point, we would not expect, this is a breakout. Plus, we already had a bounce here. We after this breakout and the bounce, this combination, we're not expecting price to maybe make a little bit of a dip, but ultimately this low, or at least this fractal, are good placements, should be sturdy levels for stop loss placement. Now, if you're looking to keep the stop loss small, then you wouldn't use the fractal, but you would use the candle low. Now, it's not maybe gigantically small, right? We're still looking at about 100 pips, unfortunately. But in this case, I don't see how you can make that tighter. Maybe with this candle, you might consider, because we have 2 candles in a row and 3 bullish candles in a group of 4, you might consider this low. It wasn't a fractal yet at that point. And it's a little bit risky, but if you're really specifically looking for a tight stop loss, you might think about that one and go at about 130.40. And if you have this entry here at 130.94, it's 54 pips in that case. Now, mind you, this is the 4-hour chart. So stop losses are going to be a bit bigger than the hourly chart or 50-minute chart, but that's the idea. So one idea is using clear, strong candles. A second idea is using kind of a combination of candles to understand that a pivot, a change momentum, a change has a. All right. In this case, this candle kind of confirming we have a higher high, higher low. So confirming that start of the upside. We can use fractals, but that wouldn't make necessary your stop loss that small. You can use confluence of support resistance. So if there's a lot of support in this case, if there's a pivot point and a moving average and a fib, and you think that this is a particularly strong level, you could use that too. You, in theory, could use the invalidation level, but typically invalidation levels are further away. So that would not keep your stop loss small. But yeah, you can use confluence maybe on lower time frames if you really want to keep your stop loss small, to find a spot that might work decently. Let's see. Let's take a look at a different example. Let's see if we can find, I don't know, let's take a look at this hourly chart then. And let's see. Well, the example that we could do is here. Excuse me. So we have trend is aligned, 21 EMA below 144 EMA, and we have a retracement into the 21 EMA and a rebreak below it. So if you take this breakout candle right here, right? Well, in that case, I would go above this fractal. And well, euro pound is in particular, it's quite small in the euro pound, but that could work above this fractal in that case. And if you have another breakout, the second breakout here, you might even use the candle high, actually, for instance. So typically, fractal candle, I think, are okay. Yeah, good point. There was a bullish candlestick pattern here, and it could be a reason why to skip this particular break, indeed, and wait for this break. And that would have been a better moment. Although actually it was before the weekend. So, and forget that. But let's forget the weekend for the moment. Just like a medical situation here for the moment, because I wouldn't trade that close before the weekend. But if you did, it would have worked out okay. But just let's say that was not the weekend. So yeah, you might skip that because of this. But this candle breaking below the low, breaking below these lows, close below the 21 EMA, and you could use the high for the stop loss. So typically, I mean, the best way to keep your stop loss small, I think, is really candle highs and lows if it's possible. That's basically my view. That typically will give you the best opportunities, roughly speaking. You could go even tighter than that, I guess, if you use some kind of confluence, I would say. Are there any questions? Ali is very active, and I appreciate that a lot. Are there any other questions? All right, so the dollar yen totally invalidated what I thought, because I was looking for a bullish continuation, but it didn't confirm what I was looking for either, so I didn't trade it. So, that's one of the benefits for waiting for confirmation, because in fact I was bullish in this zone, but I didn't trade that. And if I would have traded that because of my in a way bias, my analysis, that would have been a loss, and that most likely a loss because it's really moving down a lot. My stop loss would have been somewhere probably below this fractals, and price went through that already. So, but because I waited for a confirmation, which was above the R1 and 21 EMA, I avoided that. But you want to be careful with using candle lows as well. I mean, here you have a breakout. All right. This candle is breaking above the 20, this fractal, but it's a small candle, right? 13 pips. And the low is in the 21 EMA too, right in the mark. So that would not be a good candle really to use a candle low. It's a very tricky thing. You don't always want to use candle highs or lows. You want to be careful of that. You don't always want to necessarily have the smallest stop loss. Small stop losses is good in a way because you can, of course, try to get a better R2R ratio, reward to risk ratio. Then again, if you have a little bit of wider stop loss, you do have the opportunity to use a trail stop loss and cut your loss short. So if you can reduce the loss to half or a quarter, then that's great. So you can do that a little bit easier with a bigger stop loss. So you want to be careful with the candle high and low. Generally speaking, look at the candle structure, look at the size of the candle, look at whether the bulls or bears are clearly in control, which means the size of the candle, but also the candle high versus the candle close versus the high or low. Look at where the candle low or high is. This low is right in the middle of the moving averages. Here it's towards the bottom. The bests are, at the bottom of the 21 EMA, for instance, not so much above the 21 EMA if you're looking for upside. And confluence in general as well. So and give it a little bit of a space. Typically, like, don't go one pip below it. You do see this kind of like a zone, right? The zone of support or resistance here. But yeah, sometimes the candle high works, candle close works well. In this case, it does work well. And the candle is relatively small. It's a little bit bigger, 22 pips, better than 13. I think is there any main difference? I don't know. Maybe in both cases, it's better to use these fractals here. But if you do use this candle low, it worked well, and you got a great small stop loss. But if you use these fractals, it would have been fine as well if you went 10 pips below that or so, right? Then you're looking at also 40 pips, not bad, right? Maybe if you use the low, maybe 25. Now, sometimes it works out in this case. In here, somewhere in here, it didn't work out. I don't know where we were looking at. Let's see. I don't remember. Oh, it was a different time frame, I think. And sometimes, we don't know. This is a relatively small candle too, 20, 22 pips, I think. So that's sometimes a bit tough to choose which stop loss to use. If you want to be safe, use the fractals here, a little bit of space here, and it depends on the conditions of each chart as well. This candle, if you take this candle, then I would go for the low because it's a decent candle. You have 3 candles in a row, and I think that this is a pretty strong candle. So for relatively speaking, it's all about relative. So it's a fair thing to use the candle low in this case. Looking at the entire market structure helps. I think about even the candle low here because you see clear momentum to the upside. You see price bouncing after 38.2 fib. You see price retracing the 220 MA, first break, retrace, second break. This is the second break. A second break helps as well and makes it less risky. So then when it's less risky, a tighter stop loss is also better. And excuse me, triangle chart pattern as well. All right. And the difference between here and here is that this was a bullish correction, whereas here we had bearish momentum, by the way. And because of that bearish momentum, and we have choppy upside, all right, the entire situation is different. All right, you have momentum up, sideways correction. Here you have momentum down, sideways correction. Another factor to look at chart patterns, and then realizing break patterns. This is the second break. Plus, we have a triangle pattern. So we have a triangle pattern, and we have a. Wait 1 second. We have triangle pattern, and what was the second factor? A second break. Sorry, we have a triangle pattern and a second break. Here we have bearish momentum. Okay. So, and here we have a second break too, by the way, but we do have bearish momentum. But if you trade this candle and you go with the low, then price did go sideways for a while, and you might consider some trade management to exit that trade. That's a different story again. But with so many candles going sideways, you might consider trade management, or if you waited for this breakout, you might move it to break even at that point, right? Yeah, I don't know if that, I guess that's about it at this moment. So I hope that I managed to help tie the pieces a little bit together with some practical examples. It's now, theory is not, I guess, that complicated, I guess, right? It's 2 triangles, but yeah, it's all about combining those factors on different time frames. And trying to make the right, weighing the right decisions. And that's a question of practice, question of evaluating, getting feedback from the market, and learning from that and getting better every time. And that's just a question of practice. Okay. So if you have any questions on the educational elements, let me know. Howie, I talked about the gold in the webinar today, but very quickly, basically, no problem. But I can tell you quickly that I don't for upside, I don't like the bounce at the 88.6 fib, bearish momentum, and pretty good bearish candles, but weak, sideways candles here. So from my perspective, the bearish breakout doesn't look that great indeed, or it doesn't look good because of the wicks. But the bullishness, I personally don't like. And it might fly up here, so don't blame me if it does. But it looks like corrective to me with the bearish momentum, plus all those daily candle patterns. So yeah, if anything, it might move up like that and then make a false break and then break to the downside. That's my bias, basically. But don't blame me though if it flies up. All right. That's it then. Thanks for joining. Wish you all great trading, everyone, boys and girls, and ladies and gentlemen, and see you very soon. Cheers.